Welcome to the Deep Dive. Today we're tackling probably the biggest economic news folks have been waiting for, the Bank of Canada's rate decision.
Yeah, it's definitely been circled on a lot of calendars.
And if you're listening, you probably need the quick takeaway, especially if you're one of those, prospective home buyers who felt completely stuck by those high rates recently.
Exactly. So our mission today is really to cut through the noise, use the source materials we've got, and figure out the real implications of this shift.
What does it actually mean for mortgages?
Yeah,
And maybe, just maybe, what does it say about where we are in this whole market downturn thing?
that's the core of it, because the big immediate signal seems to be that rate cuts are back on the table.
Right. And experts are, well, maybe cautiously is the word, pointing buyers back to the market.
Because we're shifting, potentially, from rates that were stubbornly near 4%
Ugh, yeah, that 4% wall,
to the real possibility of seeing mortgages soon in the 3% range.
which, that feels like a different world for affordability, doesn't it?
It really does. A potential game changer.
Okay, so to get there, to understand how a Bank of Canada decision turns into a cheaper mortgage, we need to look at the central action first. What exactly did they do?
Yeah, let's start there. Technically, the move was pretty straightforward. They lowered their policy interest rate by a quarter point.
A quarter point. Okay. Not huge, but significant because it's the first cut in quite a while, right?
Exactly, after months of just holding steady. And that brings the policy rate down to 2.5%.
2.5%.
Yeah.
Now, help connect the dots for us because that 2.5% isn't the number you see advertised on a mortgage billboard.
No, definitely not. Think of the policy rate as like the base cost for commercial banks to borrow money overnight from each other or the central bank.
Right, the foundation.
Precisely. And that rate directly influences the prime lending rate at the major banks.
Which is a rate consumers sometimes see, like on lines of credit.
Correct. So when the BBOC cuts its policy rate, the prime rate usually follows pretty quickly. And once that happens,
But the banks have more breathing room.
they do. They can afford to offer lower rates on consumer products like fixed rate mortgages. And the expectation is that those could dip into that 3% range fairly soon after this cut.
Okay, so the 2.5% policy rate is like the key that unlocks the door to potential 3% mortgages. Got it.
That's a good way to put it.
But why now?
What was the bank's official reason, their justification for finally easing up? Why hit the brakes? Or rather, ease off them?
Well, the sources point to two main drivers here.
Hmm.
First, they mentioned seeing signs of weakening employment.
Weakening employment. Okay, that sounds a little concerning, actually.
It can be. We'll maybe circle back to that nuance. But
Yeah.
the second reason was seeing more evidence that inflation is becoming less of a major worry.
So inflation cooling off gives them the green light, essentially.
It gives them the room to maneuver, yeah.
Yeah.
They likely feel they can cut rates now without risking another big surge in prices. Okay, but let's circle back to that weakening employment point you raised. Because if that's part of the rationale, isn't that a bit of a red flag for someone thinking about taking on a big 3% mortgage?
That's a really important question. It highlights the tightrope the Bank of Canada is walking.
Yeah, it sounds like it. Relief on rates, but maybe worry about jobs.
Kind of. The BAPOC is likely betting or hoping that the weakening employment is just sort of the necessary cooling off after fighting inflation. They're hoping it doesn't turn into a deep recession.
A soft landing. The elusive soft landing.
That's the goal. So this cut is almost like the bank saying, okay, we think we've done the hard part on inflation. Now let's start normalizing rates before we accidentally cause too much pain.
Normalizing. Okay. So it signals the end of the really aggressive tightening cycle we went through.
That seems to be the message, yes. The primary mission of slowing inflation is seen as largely accomplished or at least well underway.
Okay, that puts the immediate financial impact into sharper focus then. Let's talk about that tangible benefit. For someone looking for a loan right now, what are lenders expected to do, like tomorrow?
Well, maybe not tomorrow morning, but very soon. The expectation is definitely encouraging. We should start seeing lenders advertising mortgages, fixed rates particularly. That could be in that 3-point-something% range.
And that jump down from the 4% zone, even if it's, say, 3.8 versus 4.8, that makes a real difference month to month, right?
Absolutely. On a typical mortgage size, that's potentially hundreds of dollars less each month. It adds up fast.
And that saving, that perceived shift, could be a huge catalyst. We saw that observation from Rochelle Young-Lay, suggesting this cut might be exactly the sign first-time buyers have been waiting for.
Yeah, people who've just been completely on the sidelines, frozen by the high costs and the uncertainty of where rates were going next.
So why is 3% the magic number? Is it purely the math, the lower payment?
The math is huge, obviously, but there's a big psychological piece too, isn't there?
Explain that.
Well, for a lot of people tracking the market, maybe younger buyers especially, 4% or higher felt abnormal, aggressively high, like a crisis rate linked to that whole pandemic inflation spike.
Right. It felt temporary, but painfully high.
Exactly. Whereas 3 point something, that feels more like a normal cost of borrowing money long term, something you can budget for, live with, without feeling like you're locking in at a crazy peak.
So it's not just, can I afford this payment? It's also, does this feel like a reasonable, sustainable rate?
Mm.
The fear factor diminishes.
Precisely. That removal of the psychological barrier, that return to perceived normality, could be just as important as the dollar savings in unlocking all that pent-up demand.
Builds confidence.
Confidence is key. You know, the market isn't just about houses, it's about the willingness and ability to borrow the money to buy them. Lower normal rates boost both.
That makes sense, the motivation factor. But let's zoom out again. One rate cut is good news, sure. But does it mean this whole painful housing cycle correction is actually over? Or is this just, I don't know, a temporary pause in the pain?
That's the million-dollar question, isn't it? To get a handle on that, we looked at some analysis, specifically from Mandeep Tour over at OMAXE real estate team. They offered a pretty distinct view on where we are in the grand scheme of things.
Okay, and what was their take? How do they frame this moment in the cycle?
Their assessment was quite direct, actually. They basically said this rate cut, quote, is kind of showing the cycle completing its downfall cycle.
Wow, completing its downfall cycle. That's a strong statement. It implies the worst of the downturn is behind us.
It does. It suggests the period of aggressive price drops or market fear is essentially ending or has ended. The downward pressure is easing significantly.
Okay, that's a big call. But if the downfall is complete, what does that actually look like right now on the ground? Are houses suddenly flying off the shelves?
Not necessarily, and this is where their analysis gets interesting. Tour also noted that currently the market might still, and this is another sort of fragmented quote but telling, look-alike market is not moving at all and became stuck or sit still.
Stuck or sit still? Okay, let's unpack that. So the policy has shifted. The potential for lower rates is there. Maybe the psychology is starting to turn. But actual activity hasn't picked up yet.
That seems to be the observation. It's like the engine has been turned back on, but the car hasn't started rolling down the road yet. There's a lag.
Inertia.
Exactly. The market is kind of static right now, absorbing the news, waiting for those lower rates to actually materialize widely, waiting for buyers and sellers to react.
And that lag, that stuck period, is maybe important.
It could be. It supports the idea that what follows isn't necessarily an immediate explosion in activity, but more of a gradual recovery.
Yeah.
The projection seems to be that, maybe after a few months, maybe give a year, we'll see more decisive signs of the market recovering.
So the rate cut isn't the recovery itself. It's more like the starting gun for the recovery phase.
That's a perfect analogy. It's the inflection point that kicks off the potential for recovery.
Okay, let's push back on that a little, though. If the market is currently stuck, and the recovery depends on buyers feeling confident enough to jump in, maybe lured by those 3% rates. What about that weakening employment factor the BAPC mentioned? Could that become the new reason people stay stuck? If you're worried about your job, even a 3% mortgage might seem risky.
That's absolutely the counterargument, the potential headwind.
Yeah.
You could swap interest rate paralysis for job security paralysis, or maybe just general economic uncertainty paralysis.
Right.
However, the thinking in some of the source analysis seems to be that the sheer level of pent-up demand, particularly from first-time buyers who've been locked out for so long,
Yeah, there are a lot of...
is so high that even a modest improvement in borrowing costs will likely outweigh moderate job market concerns, at least for those who do feel secure in their employment.
So for those still working and feeling okay about it, the lower rate is just too tempting to ignore.
It acts as a really powerful structural incentive, yes. It might be enough to overcome some of that broader economic anxiety for a significant chunk of buyers.
Okay, let's try and synthesize this for everyone listening.
Yeah.
We've got the Bank of Canada dropping its policy rate to 2.5%.
Sure.
That action directly paves the way for lower mortgage rates, possibly getting into that 3% something range.
Right, that's the fuel.
And that fuel, the lower rate, provides both the financial means and, crucially, the psychological boost
The confidence.
for buyers to finally step back in and push the market out of this stuck or sit still phase that Man, deep tour described.
Yep. And into what's predicted to be a recovery phase, maybe starting gradually over the next few months to a year.
It sounds like a clear chain reaction then. Rate cut leads to lower mortgage potential, which signals the downturn is ending, which gives buyers confidence, which starts to unfreeze the market.
That's the thesis. The rate cut isn't just about the monthly payment. It's about breaking that log jam of fear and uncertainty that kept transactions frozen.
So if you were sitting there waiting for some kind of definitive sign that the market wasn't, falling off a cliff anymore.
This might be it. The idea that the downfall cycle is completing, combined with the return of potentially normal-ish 3% mortgages, is a pretty strong signal.
Okay, this has been a really vital deep dive, I think. We've covered the BOC's quarter-point cut.
Driven by those twin signals. Easing inflation and, yes, that potentially worrying sign of weakening employment.
And we've analyzed how that translates directly into the possibility of 3% mortgages.
Which experts, like Tor, see as marking the end of the market's painful downfall cycle.
The whole landscape really does feel like it's shifted.
It does, and these next few months, this transition period, feel particularly interesting. Which brings us to a final thought we wanted to leave you with.
Yeah, something to chew on based on this tension we've uncovered between the policy shift and the current market reality.
Right. If the experts are saying the market right now is effectively stuck or sits still.
Meaning maybe less competition, maybe sellers are a bit more nervous or motivated.
Exactly. But at the same time, the confident prediction is for recovery to start picking up steam in, say, a few months or within the year.
Which implies more buyers, more competition, maybe prices starting to climb again.
Then how should you, the potential home buyer, think about this specific window of time right now?
It's about the timing of normalcy, isn't it?
It really is. Do you try and jump in now while things are still stuck, potentially getting a better deal before the recovery fully kicks in?
But maybe while rates haven't quite hit their lowest point yet.
Or do you wait until those 3% something rates are widely available and advertised?
But risk facing way more competition, maybe even bidding wars again if the recovery takes off like predicted.
It's a strategic question about navigating this gap between the policy change and the market's full reaction.
That window is definitely open right now. Something critical to consider for your own timing and strategy.
Definitely food for thought. Thanks for joining us for this deep dive.
Well,